We've heard the story from the Fed chair, the commentary from her on the US economy. What's the story in the data, the signal for you?
So I think you hit it spot on. The claims data show no real problems with the labor market, and there's still not a lot of domestic price pressures that are happening. So whether it's a rebound in the second quarter that's not as strong as some people had anticipated, whether it's labor markets not generating wage growth, or whether it's a bunch of one-off idiosyncratic factors keeping inflation soft, there's not a lot of evidence that suggests the Fed's behind the curve. I think you heard that bleed into Yellen's comments yesterday. So their baseline view of the outlook remains the same, but it seems like there's a little more concern about inflation than she had expressed around the time of the June meeting, and I think markets are reacting to that.
Michael, as you see things now, how the data informs your view and how you think the Fed should execute monetary policy, is that very much in line on how you think the Fed will actually execute monetary policy?
Yes, and so what I would say is they're committed to getting balance sheet runoff started. They've got a preset path on that. They do want to let that run as much as they can in the background, and they'll adjust to the ebb and flow of the economy with front-end rate hikes. So I think they'll skip a hike in September. It'll give them more time to assess the underlying state of activity and inflation. It's still likely that they go again in December, but if inflation isn't rebounding as they expect, you may get a flatter path going into next year. So the delta on Fed policy will come on the rates path, and I think it's if markets are right to expect runoff, but also discount the number of rate hikes the Fed has penciled in at the same time.
Nandini, it strikes me that Janet Yellen, in her testimony yesterday, illustrated sort of an issue that she has that's illustrated exactly in these numbers. On the one hand, the job situation is really going well. People are getting employment. That's terrific. On the other hand, inflation is not coming along the way she would have expected, the way the models would have predicted. That's a problem for the Fed to figure out what's going on with the models, whether inflation is coming. Is it an issue for investors? Should an investor care that, in fact, the inflation is not picking up the way we would have expected?
I think it is more of an issue for the Fed. You know, it's the classic issue where the dual mandate, one of the mandates being hit very strongly with unemployment at record lows. Those claims numbers we're seeing staying low as well. But again, as you say, inflation just not staying above that 2%, which is, by the way, not a limit or a cap on how much inflation should be, but a sort of central goal for the Fed. So the fact that these inflation numbers are looking a bit lower is a problem for them. From an investment point of view, you know, especially sitting globally away from the U.S., what we care about is what happens to the rates market. And you can already see that this year, the 10-year rate hasn't been increasing in the way you'd expect, given one more possible rate hike, making a total of 3 on the table for this year, and that balance sheet reduction. So we are watching very closely what's going to happen with the yield curve, especially on the long end, which are more sensitive to the balance sheet reduction that should start sometime this year.